G'day and welcome to the Grow a Small Business Podcast. I'm your host, Troy Truen. Each week, we speak with an owner who has grown a business with 5 to 30 team members to something bigger. Diving into their numbers and unearthing the pain they've experienced, we explore what they did to overcome each barrier and what they would do differently from day one. Let's get into it.
Well, Ethan, thanks so much for making the time to catch up. As I mentioned, I'm really looking forward to this discussion because getting access to funding is often a topic of discussion with small business owners, particularly those looking to grow. I guess as a starting point, give me a little bit of an introduction to you. How did you end up in this game?
Absolutely. So yeah, it's great to be on the podcast, Rob, and to hopefully share a bit of the messaging that we're currently seeing in the market and how Fundabl are currently supporting businesses. So how I got into the space is I actually sat on the other side of the table, investing equity into businesses, predominantly prop tech and fintech opportunities. And I'll never forget, there was a few founders that came to our offices one day looking to raise what was a significant amount of capital, but they were looking to dilute quite a significant portion of their ownership in order to raise the funds. And I thought that to be a more business owner friendly offering that rewards businesses that are doing nicely and just don't want to dilute yet or dilute as much, and didn't quite fit the mold towards equity funding or being able to receive bank debts. And there was a nice market of clients that were looking to be able to grow their business without needing to give up ownership or to go through the process of having to secure other forms of funding, which can be at times time consuming and have some onerous terms.
Yeah. So I guess for the benefit of our audience, can you explain what does this non-dilutive funding look like? How is it different to equity or debt in its typical forms?
Yeah, absolutely. So in simple terms, non-dilutive means funding that results in not giving away any of the ownership in your business. So when you kick off a business, if you kick it off with a business partner or by yourself, you will have a percentage ownership of the business. That's obviously the greatest value that you retain within the business.
Yeah.
So a lot of businesses are looking towards alternative or non-dilutive funding options in order to maintain their equity upside and to keep hold of their equity so that they can ideally reap the benefits if they were to sell the business or to be able to get to a profitable position and could pay themselves dividends. So they're maintaining their equity ownership.
Yeah, excellent. And so how is it different from debt? I mean, is this essentially debt or is it a little bit different?
So there are different forms of debts. Some debt is completely non-dilutive. There is also other forms of debt, such as venture debt, which might have equity components to the capital that is provided in the form of warrants or equity options.
Yeah.
As part of the funding that's made available. So that's also one important consideration for business owners, is to make sure that they're fully across all of the details when they are signing to debt-like arrangements, where they might be of the view that there aren't any equity kickers in the agreements, and to just ensure that it's completely non-dilutive if that's the path that they're looking to go down.
Yeah, okay. Great. So tell me, who are the typical businesses or business owners that come to you guys, and what are they looking for? What's their problems that would cause them to come to you as opposed to going to a standard bank or looking at all the other different sources of funding that might be available to them?
Yeah, absolutely. So maybe as an initial, just to share a little bit more about what we do.
Yeah, great.
Effectively, we offer a facility. We go by the term of trading limits that a business can use as they grow. There's no commitment to draw the full facility that's made available. You just pay on what you use. And ideally, the limit that we make available continues to grow as the business grows.
Okay.
Each drawdown is its own separate tranche, and that's paid back in equal monthly payments over up to 12 months. So it's very simple from a cash flow budgeting perspective. Some of the use cases for our funds, I'd say there's probably 3 main use cases, Rob. One, just to be able to smooth cash flows or to manage point in time cash flow bottleneck, extend runway, a bit of an insurance piece if there was some timing mismatches between capital coming in and out of the business. So that's the first use case. The second use case would be to be able to accelerate growth faster than you can through organic means. So whether that's purchasing equipment or inventory or investing in business development efforts, marketing, tech builds in order to ideally meet client demand and to grow the business. So that would be the second use case. And then lastly, we've got a nice portfolio of clients that have used us as a way to either bridge or to complement a capital raise that they might be going through, particularly relevant in the current funding environment and the current times where raising capital might be challenging for some. It's no secret that the pace of funding has slowed and it's a much steeper climb to close. So that's been a nice use case of our funding. So they're the various use cases. In most scenarios, we support a range of businesses from SaaS, tech-enabled businesses, professional services businesses, and other online businesses. And some of the main reasons why a business would come to us over the likes of a bank is, one, the speed at which we operate. So we can provide funds within as little as 24 hours. We're incredibly quick. It's generally at least up to. So that's incredibly powerful for businesses that know exactly where they can allocate dollars into the business and generate a greater ROI. And speed is very critical to them to be able to execute on their growth plans. So the speed as well as the flexibility of our offering. So we allow businesses to be able to incrementally draw funds as and when they need it. There's no need to draw the full funds that are made available. You're not locked into some commitment where you're paying an exuberant amount because you've got this huge facility outstanding, but you're not using it all on day one. So we provide business owners with that flexibility to be able to use it as they require and to pay on what they use. And then the simplicity of our offering. So there's no personal guarantees involved in our offering. It's paid back in equal monthly payments, so it doesn't fluctuate based on how your revenues are performing and catch you up if you are performing nicely, and provides business owners with the flexibility. It's a very simple product to understand.
Yeah, sounds fantastic. So tell me a little bit about the process that's involved in working with you guys. You know, if someone was looking to access some funds, I'm assuming typically are people connecting with you online, or what's the usual process that someone will go through?
So the process is super simple. Effectively, it's all online. You can apply through our website, and then on completion of our onboarding form, you'll be redirected to our platform to provide 3 pieces of onboarding material. The first being read-only access to your Xero or your accounting software. Secondly, recent bank statements. And lastly, a summary of your revenues by clients. So between the 3, it's a couple minutes sort of onboarding process. And from there, it's a pretty quick steer and relatively self-serving from that perspective.
Okay. So access to, for example, a Xero file, read-only, bank statements, and clients,
and a client summary, a subscription, a summary of is perfect.
Wow, yeah, that does sound very simple. And what then happens behind the scenes? How do you turn this around so quickly? Like, you can make decisions.
That's our secret spices, Rob.
Okay.
So we've worked incredibly hard to build out our own proprietary underwriting model and to quickly assess and analyze clients and to provide them with the trading limits and the cost of funds. Yep. So we ingest all of the information that's provided and we input that into our proprietary model.
And from there, you can then offer, look, here's the limit, and I'm assuming some sort of repayment schedule or...
That's exactly right. So we'll work with our clients to see what they need at that point in time. I'd say more than half of our clients would draw funds sequentially, so they won't draw the full funds all at one go because there might not necessarily be a need for all of the funds on day one. So they might draw initial amount, and we'll work with them so that we can create a schedule or work towards their needs to be able to best suit the needs of the business.
Yeah, brilliant. Well, that sounds great.
Want to become the best manager you can be? Check out our Kick-Ass Manager course at growasmallbusiness.com. Do the course and add your fellow managers for no extra cost. Join the 30%. 70% of people quit their job because of their manager.
So give me an example of sort of a typical story of a client that works with you without giving too many secrets away around who you're working with, but what have they been able to do when they're working with you? What are some examples of what people can achieve?
Yeah, absolutely. So as I mentioned, our product particularly resonates with businesses in the professional services field. So whether that's, all forms of professional services, as well as other SaaS or tech-enabled businesses, and as well as some online businesses as well. And generally, they're using our funds to be able to accelerate growth faster than they can through organic means, or to unlock some expansion plans, to bring forward some expansion plans. So one particular use case that comes to mind, and I wouldn't be able to share the exact client's name, but they are Australian based and they're a professional services business, and they were looking to bring on some new salespeople to be able to expand into new markets, as well as to build out a bit of their tech. And they drew some of our funds and were able to, they actually almost doubled their revenues within 60 days.
Wow.
It was quite remarkable. They took our funds and they launched in the States and put 2 BDMs and a SDR in the States. And they were able to, almost double their revenues in 60 days, which was a remarkable success story. And it's great to see some of our clients being able to, using our funds to grow their business. It's incredibly rewarding.
That's awesome. Without putting too much of a depressing turn on this, but tell me about some of the businesses that you can't help, that you can't offer funding to. What's usually the missing bit that causes you to knock them back, or say, look, come back again when you've got things in order?
Yeah, it's a great question. So there's 2 absolute minimum requirements that us at Fundabl require to be able to support a client. One is that they've got an Australian entity with some revenues flowing into that entity. Okay. The second absolute minimum requirement is that they've been generating at least 25K a month for 12 months.
Right.
They're not the 2 main things that are resulting in us knocking clients back. But lastly, we more as a general requirement, the business needs to have at least 3 months of cash runway, or at least we need to have enough confidence around incoming capital coming into the business in addition to our own funds. So that's generally around an equity raise or an R&D grant or enterprise contracts or seasonality in revenues. So effectively understanding what we'd be bridging towards. So where we're typically having to sadly knock clients back is they're coming to us too late and they haven't quite optimized their capital stack, or haven't quite timed it to coming to the likes of a Fundabl to be able to be lendable or fundable. They're coming to us a bit too late. So the suggestion would be to those listening is to don't leave things too late to approach your potential funder. Put yourself in the best scenario and have the greatest chance of being able to receive funding by coming to a lender where you've got enough cash runway in the business. Ideally, you're at break even or profitable, but at least with enough cash runway, the business is growing, they've got strong metrics, and that makes it a much easier process on our end to be able to support.
Yeah, no, that makes perfect sense. So I guess my final question for you today, Ethan, you've obviously seen so many different businesses, both successful and I'm assuming some potentially unsuccessful. If you had one piece of advice for ambitious business owners to take away from this podcast, and I guess something they could implement or consider when they get back to their desk, what would it be?
It's a very good question. One thing that constantly comes to mind is the underutilization of alternative funding options to support businesses throughout their growth journey. So too often we're seeing founders either not having enough skin in the game to be able to excite investors, or not having enough skin in the game to excite themselves to be able to prolong the journey, which is a very tough ride. You sign up for something has its peaks and troughs, and too often we're finding that clients are coming to us with not enough skin in the game, so they're finding it hard to raise equity, and they themselves are also not as incentivized to grow the business. So I think that there's this perception that equity is it's the all or nothing route, and there's definitely more than one way to construct your capital stack. And founders and business owners might also not necessarily be the most naturally skilled capital allocators. So there's a lot of resources out there and other, if you speak to CFOs and other financially savvy individuals that would be able to direct you as to whether there might be a more optimal funding option out there to get you from A to B without needing to dilute, or be able to raise funds more quickly or with some greater flexibility, or not being able to on more attractive terms or rates, or without personal guarantees. So my advice would be to see if there's a more optimal way to be able to grow your business using alternative funding options. Understand also the expectations of the funders that you're getting capital from. So if you had raised capital from an equity provider, there's certain expectations as to revenue growth, and you have to be excited about that, and you have to know that you're going to be able to hit those milestones to be able to keep them interested. And obviously different investors and funders have different hurdle benchmarks to be able to hit, to be able to support. So that's a very important consideration for all business owners.
I actually think I think you gave us probably within your piece of advice there's about 10 nuggets of gold, but I think that's a really good point, is that there are these days so many options when it comes to funding. And I guess if you're a business owner and your head, as it should be, is just in the business and your clients, it's sometimes hard to be across all the different funding options that might be available to you. So potentially trying to get some good advice around what your options are and exploring what I'd term as non-traditional, although they are becoming more and more mainstream, but looking at all the options and deciding what's the best fit. Well, Ethan, thank you so much for your time. That was a really informative discussion. Certainly from a personal perspective, it's given me a lot to think about, and certainly be a great opportunity for me to talk about your business with my clients, but also other funding streams that are available, and thinking through what are the best options for people. So I really appreciate your time and your insights. It's been great.
Thanks so much. It was a lot of fun. Thanks.
That's it. Thanks for listening. Please leave a review in iTunes or whatever platform you listen to us on. It means more small business owners will find our cast and help people with their business growth journey.